Thanks for joining us today. This is the Luxury Cashflow podcast, second episode. Today we have Brenten Blakeman. He is the founder of My Cost Segregation Pro, which is essentially a tax consultancy for real estate investors. And your specialty, among many things, is cost segregation and depreciation, which I'm going to be a student today. I wish I knew even a tenth as much as you, but I'm here with a notepad. I'm going to take notes and try to learn as much as I can from you. But if you could maybe just introduce yourself and kind of, what, in your words, what My Cost Segregation Pro is and kind of how you got to this point in your career.
Absolutely. Thanks for having me, Ross. This is great. Super excited to educate everyone on what I do on a daily basis. So My Cost Segregation Pro is a tax consulting firm that helps real estate investors with all of the niche stuff within the tax code to help them defer and deduct on their taxes. Most savvy real estate investors more and more are familiar with cost segregation. It's very popular on Instagram Reels, TikTok videos and whatnot, bonus depreciation. However, there are other parts of the tax code, particularly those that revolve themselves around investors that do renovations and improvements that, unfortunately, many investors are not aware of, some of which are mandatory guidelines they need to be following. And if they did, they'd actually be saving more money. I know it sounds backwards, but compliance with the tax code when it comes to real estate investments can actually save you money.
Awesome. And so with these investors, what do you think from your vantage point is kind of the number one mistake that they're making? Is it kind of their tax professionals are just not totally equipped on understanding tax code and real estate in general? Or kind of what's, where are people making the biggest mistake who are investing in real estate as a full-time for their income?
I would say the biggest mistake is just they don't know what they don't know. Mm-hmm. It's just a lack of education. The tax code is, as we know, very complex. There's 80,000 pages in it, and it changes every year. No accountant or CPA, and not to throw them under the bus, they're my best friends, will know or can know every single page. There's a common misconception that when we graduate from H&R Block and we hire an accountant, they're going to strategize and mitigate our taxes. Unfortunately, about 90% of them are just going to prep your taxes and tell you what you owe. A very small amount of accountants are actually the strategists. And even if they are, maybe they specialize in small business owners that are in e-commerce or real estate or construction, some other specialty. When it comes to real estate, the IRS mandates that an independent third-party firm does the work that my company does, the cost segregation studies, the tangible property regulation compliance, which we'll get into. Savvy accountants, particularly those that are dealing with real estate investors, know that they need someone like me or a firm like mine that can help and assist them. The big analogy that I often use, and I'll probably say it a few times today, I am simply another seat at the table. To be a successful real estate investor, you can't do everything. Likely you have a good broker, a good lender, a good bookkeeper, hopefully a good real estate accountant. Nobody can be the jack of all trades. One of the team members that very few people know that they may need, going back to they just don't know what they don't know, is someone like myself that can work with the team to help them understand and take advantage of these tax breaks. The government and the IRS right now supported agriculture and farmers. They have always and will always support real estate investors. Real estate investors buy buildings, build new buildings, improve buildings. It creates jobs, places for people to live. And if they didn't have these incentives like cost segregation, 1031 exchanges, step up in basis, wealthy individuals would likely park their money in investments that did have these tax breaks. So, I mean, what it does is it it does a lot of good things that in a free economy, the government can't necessarily do for itself. So while these incentives are changing, they'll always be there in some shape or form. So having someone like myself can help people navigate those waters and pull the right levers to make sure that if they can take advantage of them, that they are.
Yeah, totally. So it makes perfect sense. And just to be clear, so you're not a CPA per se, but you are an all-inclusive resource that CPA can bring on, or the real estate investor can bring on. I would assume it's two-prong as far as who's picking up the phone and calling you, to just, like you said, be that extra seat at the table and make sure that the area that you specialize in is well covered within the kind of overall filings and tax code and regulations.
Yeah, could not have said it better myself. We will not replace your CPA. We will not replace your financial advisor, but it's important to have individuals like that, or if it's a small business that owns their real estate, maybe the CFO of the company, at the table, because these individuals fully understand the owner or owner's tax situation. That's one component that I don't have a full grasp on, because everyone's tax situation is different. Unfortunately, as great as these incentives are, they only fit a small niche of tax situations. If you're not a real estate professional, if you're just passively investing, a doctor or a lawyer with W-2 from, the hospital or the law firm, the avenue to take advantage of these incentives, unfortunately, narrows very quickly. So having them at the table, the accountant understands the books, the financial advisor understands what assets these individuals have and whether or not we can take advantage of them. The last thing that I'd ever want to do is have someone pay for work, create a bunch of deductions and deferrals, but they don't have the income or the right kind of income to offset, because deductions and deferrals are great, but they're meaningless without income. So it's, as I said, another seat at the table. I mean, as we can all imagine, Donald Trump has a lot of very smart people at the table, one of which is someone that specializes in these real estate tax incentives.
Yeah. And so let's dive into that a little bit. So I am curious to learn and kind of understand the nuances and the differences between, say, standard straight line depreciation, how that compares in contrast to bonus depreciation, and then where and how does cost segregation kind of tie into both of those?
Absolutely. So when you own an investment property, the tax code says that this asset will depreciate. I often hear people say, oh, you get to depreciate an investment property. You have to. There's two methods to do it. The first is straight line. It's kind of the default method. Depending on the asset class, it either depreciates over 27 and a half years or 39 years. In the case of residential or multifamily, a long-term residential depreciates over 27 and a half, and a short-term, like an Airbnb, VRBO, depreciates over 39. Why those numbers? I don't know. That's just what the tax code says. So essentially, under straight line depreciation, we depreciate the asset as a whole, like one single piece. Now, if you ever took an accounting course, or for those that have taken an accounting course, you may remember buildings depreciate, but land does not. So in most cases, unless it's a condo with no land ownership, we have to deduct off some portion of what you paid for it for land. Now, that'll typically be in the 10 to 30% range. It depends on what state. States like California have what I'll call more unfavorable land values. We want land to be as low as possible because we want to take advantage of depreciation. So simply what we do, let's say $1 million home, take off 20% for land. That leaves $800,000. If it's a short-term rental, we divide that by 39, and that is our depreciation expense every year. The great thing about depreciation, unlike when you drive your new car off the lot and it loses, 20 or 30% of its value, this is a expense that lowers our taxable income, but we're not actually cutting a check for it. You have to pay your mortgage, your taxes, your insurance, maintenance. Those are real checks, real cash that you have to pay. This is in what an accounting speak is called a non-cash expense. Lowers your income, but you're not actually sending a check to anyone. So it's great. Now, in a lot of cases, that's plenty of depreciation to wipe out any taxable income if we're just looking at the single property. Now, tax situations get complex because people own multiple properties, have other income sources, so it can quickly get a lot muddier. But that is straight line depreciation, a straight or even amount every year.
And that's simply a reduction in your taxable income. As you mentioned, non-cash value. It's just a deduction to your taxable income. Does it make any difference how you file that taxable income, whether you're W-2, whether you're 1099, self-employed, et cetera? Is it the same deduction to your taxable income, or is there variances and nuances based on your filing status?
A lot of nuances. Okay. In its simplest sense, people have three potential income sources: active income, passive income, and then like dividend and interest income. For most people, they have a W-2 job, say from a bank. Passive income sources, for our case, real estate, and then obviously dividend and interest income would be from a portfolio, brokerage account.
Right.
If you are a W-2 employee and you're passively investing in real estate, there is a distinct line in the sand between your passive and your active income sources. All the depreciation benefits and whatnot, the taxable income is completely looked at separately. Now, if you are a real estate professional and you're investing in real estate, that line in the sand may not be there. In which case, if you have, if you're building custom homes or you have brokerage income, you're a real estate agent, you potentially have the ability to take depreciation benefits and they all just become one bucket. That line in the sand is not there. That is a situation in which, that door opens up. It's a somewhat more of a rare circumstance because a lot of people have W-2 incomes and they wouldn't be able to justify themselves as a real estate professional. Well, I know we'll get into it, but the IRS is a very big stickler about qualifying for that. So trying to skirt the rules on that status to offset, W-2 income is a very dangerous game.
Got it. So more in simplistic terms, if I'm understanding you correctly, that straight line depreciation method reduces the tax liability on, with maybe some nuances, the passive income status. So let's say it's a $20,000 reduction in tax liability. If you have rental properties that are creating $20,000 a year in passive income, that would be non-taxable, essentially. That would be a net neutral scenario.
Correct. Exactly.
Versus if you didn't, and let's say you only had, or maybe if you did, but it's only a $10,000 annual income passively, but you have a $20,000 quote unquote, I hate to use the word write-off, I'm sure for the people watching, we might call it write-off because they'll know what I'm talking about. Yeah. Then that first 10,000 is reduced, and then do you just not get to take advantage of that second 10,000 in depreciation that won't roll over to W-2?
Income? We can't touch the W-2. Now, if the depreciation brings your taxable income on this property down to zero, it's not a use it or lose it. It simply carries over. And that's an instance where, in a vacuum, the property's not producing enough income to need any more depreciation. Straight line depreciation is taking care of it. Now, it can get a lot more complicated if we have 2, 5, 10 properties or some properties that are producing, a significant amount of taxable income after mortgage, taxes, insurance. Mm-hmm. Or if they qualify as a real estate professional and all of a sudden our income buckets are combined and we've got a bunch of brokerage income, and this real estate broker is managing, 5 Airbnbs. That's where, the, cost segregation, tax deferral benefits really can get fun because there's a lot of taxable income that we can essentially wipe out.
Got it. Makes good sense to me. Now, you mentioned long-term rentals depreciate over 27 and a half years, short-term rentals over 39.
Correct.
Putting just a pin in that for a second before we get into the actual cost segregation aspect, how can someone use straight line depreciation but bonus depreciate so that instead of, say, 27 and a half years for a long-term rental or 39 years as a short-term rental, they can basically get a larger reduction as far as their tax liability more over the course of 5 years or 10 years or however that works to potentially be able to bonus depreciate?
So bonus depreciation is only eligible to be applied to items that have been placed in a class life less than 20 years. So there's essentially 4 different types of class lives. And a class life is how long a certain item or component or building depreciates over. So with straight line depreciation, we look at the building as a whole, and it depreciates over the full term, the 27 and a half or the 39, depending on the asset class or, if it's a long or short term. So good segue into cost segregation, because to be able to apply bonus depreciation, we have to segregate or itemize every single component of the building into, according to the tax code, what I would call more appropriate class lives. For example, when we do cost segregation, again, we don't look at it as a whole. We're looking at the Lego pieces instead of the finished, the full product. So if we're looking at a single family home, floors, carpets, cabinets, door frames. I mean, there's a lot of components that make up this home. You're in the short-term rental business. If you have Airbnb customers coming in every weekend and your bedrooms are carpeted, is that carpet going to last 39 years?
Nope.
Exactly. So it makes more sense to depreciate that carpet over 5 years. And similarly, furniture, that's a 7-year class life item.
And are these timeframes guidelines within the tax code? 5 years,
yes,
7 years?
Everything,
so everything that's itemized that
yes.
you have the ability to quote unquote bonus depreciate has a kind of a, call it, lifespan attached to it?
Correct. So cost segregation is simply, it's a part of the tax code. A lot of people are like, oh, this is some aggressive form of depreciation. It's like, no, it's in the tax code. It's method 2 for depreciating a real estate asset. Now, with method 1, straight line depreciation, all your accountant has to do is apply a land value, take the remainder and divide it by 27 and a half or 39. Any accountant in America can do that. Now, to do a cost segregation study, the IRS wants you to have an independent third party do it. But also, if an accountant does this and they're not trained in it, they could be putting themselves at risk or liability. But all of this stuff is in the tax code. So we simply are following the rules and just applying it accordingly.
When you go the route of cost segregating, is that an either or relative to straight line depreciation? Like, can you take your straight line depreciation over, say, 39 years if it's a short-term rental, but also cost segregate some of the itemized items, flooring, cabinet, doors, etc.? Or is there a component of cost segregation that actually has to do with the value of the building that's done differently than the straight line method?
High level, it's an either or. And one of the cool things is you can start with straight line, and then 5 years later, you can switch over. Reasons why you may do that: hey, your tax situation changed. The property started producing a lot more income. Or I've added 5 properties and now it makes sense. Maybe now I'm a real estate professional. Or I bought a very low basis, low cost property, and I've now invested a lot of money into it with renovations and improvements, of which are items that we need to add to the depreciation schedule. So now cost segregation makes a lot more sense because there's a lot more bonus potential to take advantage of. So with a single family home, for sake of example, we will be able to classify 15 to 35% of the property into the shorter class lives, 5, 7, and 15. The remaining 65 to 85% will still be on the full 27.5 or 39. So it's not like, oh, I bonused, a bunch of property. In 2 years, I'm not going to have any depreciation left. No, you're going to have 65 to 85% of it. Now, once the bonus portion, the 15 to 35%, burns off, is used, is wiped out by taxable income, you will have less depreciation to play with. But the concept is, I'd rather save $1 in taxes today than in 2, 5, or 10 years, because even when inflation was at 2 or 3%, $1 today is worth way more than it was in 5 years. And I think most savvy investors would agree, I can put that dollar to better use, whether it's putting it into renovations and improvements, buying another property, putting it into the market, anything. But if you continue to invest in renovations and improvements, if you're continuing to buy new properties and grow your portfolio, the train never necessarily has to stop. And then there's other tax strategies like a 1031 exchange. And with good estate planning, if you plan and maybe you have some heirs or some kids that you eventually want to pass your portfolio on to, if you do it right, the basis steps up. They pay no capital gains on all the appreciation you've got. And then, the day after you pass, your kids can call up a cost segregation firm and start the cost segregation all over again at the brand new stepped up in basis. Real estate is an incredibly powerful asset class. Now, that said, you still need to be buying good properties. You need to underwrite. We've all known people that have lost the bag on an investment. Hopefully not you and not someone, that you care about, but, it happens. But it's an amazing asset class with good planning and good due diligence. But that said, there's nuances to the tax code that are complicated.
So I think one of my takeaways there, and this is, I think, maybe a misconception from what I see related to cost segregation on, Instagram Reels and online, on TikTok, et cetera, is that people who push cost seg, it almost feels like you should be doing it do it as soon as possible within the first year or two. It sounds like that's probably not necessarily the best approach. For example, if you're planning on, I'll give you an easy example. Year one of a short-term rental almost never will generate as much as year two. We usually see about a 20 to 30% spike in its second 12-month run rate compared to its first 12-month run rate. So just on revenue alone, maybe waiting until year two or later for a cost segregation could be advantageous to the investor. Second, as you mentioned, if you're trying to build a real estate portfolio and you're starting with one, it also may make sense to wait until you just start with your standard straight line depreciation and wait until you've kind of built up a small portfolio before you enact the cost segregation strategies.
Yes, everything you said is spot on. That said, it's good to have the real estate investor, the team, the syndicate firm be aware and educated on these items and make it a continuous dialogue with their financial planner, with their accountant, to know when or when not to pull the trigger on these. The great thing is that no matter what depreciation method you use, if you have a loss at the end of the year, you don't lose it. It just carries forward. It's something that never completely goes away. Now, if you hold the property for 27.5 or 39 years and you literally invest no renovations and improvements into it, yes, depreciation can run out. I think most people are on more of a 5 to 10-ish year hold period. And with rentals, you have to do renovations and improvements. So hypothetically, the depreciation never will run out. But yes, sometimes one property in a vacuum does not warrant cost segregation. But when you get 2, 5, or if you're working to build a portfolio and then quit that W-2 job and all of a sudden you become a real estate professional, well, now you just open the door wide up, and now it needs to become more of a conversation. But, when's the time to have that conversation with someone like myself? Like yesterday. So it's not something that I would advise waiting on. Educate yourself on it so you're, more familiar and aware of it.
I think that's a good segue. I appreciate that. I think that's a good segue into real estate investment status. This is another thing that people are talking a lot about, and there is definitely a variety of tax incentives and advantages to classifying your day-to-day income activity as something related to the field of real estate.
Correct.
Are there situations, or is this kind of frowned upon by the IRS, where you can have a W-2 full-time income and a real estate investment status? And if not, how does maybe a household out of state who have, rental properties in different markets, what are some ways, if any, that they can take advantage of this status? And before I guess maybe you answer that question, maybe touch on kind of what that status actually represents to the tax code.
So the two big items to check off real estate professional status: at least 500 hours a year in real estate related activities. Not terribly hard to achieve. Your typical 40-hour a week job is about 2,000 hours. So it's not too much of a time commitment, but greater than 50% of your time in all business activities needs to be spent on real estate. So if you are working a W-2 job, all of a sudden we need to be working 2,001 hours, which is now 4,000 hours in a year, or an 80-hour work week. That, if you try to qualify as a real estate professional with a non-real estate related W-2 income, that's a huge red flag in the eyes of the IRS. The IRS became a much bigger stickler about this status when married couples filing jointly would have, one spouse that was, kind of the income earner, and then the other spouse would go get a real estate license and sell one home or rent one apartment a year. And then they would file as a real estate professional, and they would take depreciation benefits or just simply losses from the real estate and apply it to W-2 income. The IRS did not like that. So if there's one status that you should not really play games with, it's the real estate professional status.
Yeah, but what if that spouse, let's call it, there's a breadwinner and a stay-at-home, right?
Yeah.
What if the stay-at-home is actually, committing to 500 hours in actually meeting the qualifications of real estate investment status, whereas the other one is, a full-time W-2 earner?
If they truly are, then yes, that's where I need to be at the table with the financial advisor and the accountant, because I don't know the tax situation. I don't know the ins and outs and whatnot. In that instance, the ability to apply it to the true non-real estate related W-2 income is very unlikely. But yes, if that other individual is managing a bunch of properties that are kicking off a bunch of income, or they're also, selling homes, getting commissions and whatnot, yes, absolutely. But that's where...
Well, it could be anything, right? It could be real estate design, interior design. Of course. It could be, providing goods and services to, maybe a short-term rental property they own or manage or have someone else manage. Okay. Exactly.
That's where we need to have all the experts at the table and be on the same page.
Cool. And so what are some of those benefits? It basically turns what historically has been passive income into active income. So that income kind of spills over into a bucket in which you get to take more advantages of things like depreciation, cost segregation, and just the different areas of the tax code.
Yes, exactly. When we do cost segregation and we're able to apply bonus depreciation, what it does, we're not creating depreciation. We're just moving it around in a more logical sense. Like the example of the carpet, not 39 years. We're going to depreciate that over 5 years, which is more in line with how long it's going to last. So when we create this tax deferral, we front load a lot of the depreciation, as we talked about. So assuming we have the right kind of income to offset, we've now saved a bunch of money on our taxes in this year, hopefully next year. So, instead of writing a $50,000 check to the IRS, that's staying in our bank account. It's not as if the IRS is cutting us a $50,000 check, but maybe we put $50K worth of renovations into the single family home to raise our Airbnb rental rate. Well, those were essentially paid for by the tax savings.
Right. Yeah. No, I refer to it as just a reduction in the tax liability. Different than if you made a $50,000 investment into like a marketing service, right? That's obviously
exactly
a reduction, but that's a cash value. Okay. Yeah, that's awesome. Anything else that we haven't really touched on that you think is important for kind of the investor audience, short-term rental investors in particular, that you think maybe is just not talked about enough or overlooked?
I think a lot of real estate investors, a lot of my clients, my friends, are in the fix and flip game, and they're very good at it. But as we all know, fix and flips come with big capital gains tax bills. Unfortunately, cost segregation, the other tax benefits, can't do anything about those. It kind of is what it is. But if you are investing in long-term holds, the depreciation and tax benefits from those can offset your capital gain liabilities. I have a really good friend who met with me, and they're crushing, him and his partner are crushing it in the fix and flip game. And he's like, I kind of gave him the lay of the land, taught him about all this. But, the kicker was these tax benefits are only for buy and holds. And he's like, do I need to stop doing fix and flips? I'm like, no, you're really good at them. But let's start investing in, Airbnbs or multifamilies, because he's in the residential business. So that one, I like to call these mailbox money or coupon clippers. Every week you get to go to the mailbox and you get your rent check, or every month. Consistent income. Whereas the fix and flip game, 6, 18, 24 months before that one-time payout, then there's a big tax bill. So not only can you create consistent income, assuming you're doing, good due diligence and underwriting, but now we can offset the tax liability. Our eggs are in 2 baskets now. We're taking advantage of the tax code, and we have a better overall, strategy mapped out that legally reduces our tax liability. And what entrepreneur or small business owner doesn't want to increase their cash flow and pay less to Uncle Sam?
Totally. Yeah, it just kind of opens up the door for if someone gets a big, tax bill. And I've seen a number of times where people will 1031 their profits into another property, and I'll look at that property and be like, that doesn't look like the best deal in the world, but they're so gung-ho on not paying taxes that they'd rather, put their money into, a not so great deal. But buying rental properties, obviously is very advantageous, but generally, I'm a proponent of short-term rentals and with cost segregation and bonus depreciation, underwriting, executing the right deal, I think is a super valuable way to alleviate tax liability.
2 other things that I think are important for everyone listening. When you do a 1031 exchange, the IRS, shockingly, does not allow you to double dip on your tax benefits. So just for sake of example, it's a little bit more complicated of a math equation than this, but let's say you're taking $1 million home and 1031ing it into a $2 million home. And then you call me up like, hey, I want to do cost segregation on my new $2 million rental home. We cannot do cost segregation on the full $2 million home. We can only do it on the delta, or the part that was not paid for with the 1031 proceeds. Right. They don't allow us to double dip on those tax benefits. So one thing that I'll often do for clients is run a scenario analysis. Hey, do I sell the $1 million home, take the cap gain hit, and buy the $2 million home outright so I can do cost segregation? Or do I do the 1031? I'd say 2 out of 3 times, the best scenario is to not do the 1031, but sometimes, we need the 1031 to get into that bigger property. And in the long run, we want to, more doors is less risk. If I have a 6 unit and I have 2 vacancies, that 33% of my income is gone. But if I have a 20 unit with 2 vacancies, only 10% of my income is gone. So something that, again, seat at the table, let's strategize, let's talk with the team. So that's an important thing to understand. There's a lot of parts of the tax code. Some can overlap, some cannot. Now, do you have clients, investors that are doing significant renovation and improvement projects?
So significant in terms of, so we'll go in. So generally speaking, we want to buy a house that's usually pretty turnkey. I'd like to be about a 60-day run rate from the day we close to the day we have renters in there. And so we're not doing extensive renovations in terms of large scale additions, but the extent of what we'll typically do is we'll convert, offices into bedrooms. We'll do lots of hardscape, landscape. If we need to build a pool, we will include outdoor amenities that we know pay for themselves within the first year or two, like a sport court as a good example of that. And so, those projects typically range from as little as, $20,000 up to $300,000. So that's, including the furniture and just the renovations. That's usually what we're doing, but it's pretty much turnkey as far as the acquisition side.
Got it. Okay. So cost segregation is, like as we said, a lot of people know about it. It's more sexy to talk about on TikTok reels and Instagram videos. There's another part of the tax code that's got a lot of good guidance and tax breaks. But briefly, in 2014, the IRS introduced the tangible property regulations. And essentially, they are guidelines that apply to anyone that buys, builds, or improves a tangible asset, in our case, real estate. They're mandatory guidelines. So they apply to every single real estate investor in the country. But they're extremely taxpayer friendly. And essentially what they do is they guide us on, when I do X or Y renovation and improvement to a property, this is what kind of I can expense and, write off, right away. And this is what I have to capitalize or depreciate over, 5, 7, 15, or 39 years. They're extremely taxpayer friendly. Most accountants, you put a $50,000 roof membrane on the house. Ooh, sounds kind of expensive. We should conservatively depreciate that instead of writing it off in year 1. Well, shockingly, the guidelines actually say that more often than not, you can expense that. And you had to pay the roofer $50,000 this year. You don't want to depreciate that over 5 years and only take 10 a year. You think the roofer is going to take 10K a year? No chance. So working with a firm that is familiar with these can significantly increase your cash flow. But more importantly for some people, it keeps you in compliance. And I know it sounds backwards that staying in compliance with mandatory guidelines in the tax code can save you money, but it really can. The reason I also asked about significant renovations and improvements is one of the coolest parts of the tax code, which sounds super nerdy, I know, but there's this thing called a partial asset disposition, which when you're doing a renovation and improvement, oftentimes multifamily property, hey, this place is a little beat up, we got to replace the kitchens and the bathrooms. What happens to the old kitchens and bathrooms? We throw them into the dumpster and take them to the landfill. The compliance part comes in where, well, we can't have 2 kitchens in every single apartment, right? We can't continue to depreciate a kitchen that is in the landfill now. So the compliance part comes in with those items need to get removed from the depreciation schedule. The cool part comes in that we get to write off the value of everything that we throw away plus the removal cost. So the cost to demo it, the cost for the dumpster. And the cool thing about a write-off is it's not a tax deferral and it's never subject to recapture like cost segregation. Mm-hmm. So when you do a significant renovation and improvement, there's risk in that. You're investing additional capital into this property, whether you just bought it or it's 5 years down the line, and you're not getting rental income right now. But the tax code benefits us almost double, because not only the new kitchens and bathrooms you just put in, those are great for cost segregation and a nice tax deferral, but the old ones that we throw out, we get to write off the value of what we throw out, and it's based on the replacement cost. So even if that carpet's got holes or mold in it, it doesn't matter. And the other cool thing is if you just purchased the building, the basis just reset. So even if it's a 50-year-old building, I mean, some apartment complexes in Chicago, for example, or Boston are over 100 years old. If you just bought it, it doesn't matter how old it is, the basis just reset based on what you paid for it. So the value of everything you're throwing out in the eyes of, replacement and depreciable value, brand spanking new.
Yeah, that's pretty awesome.
So understanding these niches within the tax code are really important. One catch, cost segregation is awesome. It's great. You can do it, as we talked about, year 1 or year 5 or year 10, when it makes sense for your tax situation, or you put renovations into it and our basis increased to an amount that now it makes sense. With some of the write-off potential through the tangible property regulations, some of those items, if you don't take advantage of the write-off in the year that you did the improvements and threw out all the stuff, poof, the opportunity goes away. So when you brought up the question of when is it time to have a conversation with someone like me, yesterday.
Yeah.
Because if you're planning to do these renovations and improvements in 24, let's plan, let's map it out.
Right.
Let's make sure you're going about them in the right way, so that 1, we take advantage of the write-offs, but 2, there's certain ways to go about the same renovation in which, if you do it the right way, you can expense it. If you do it the wrong way, you might have to capitalize or depreciate it. Being aware of, the little nuances, and I hate to call them tips and tricks, but it's all legal stuff within the tax code. You got to have, the right people at the table. And I mean, back to your original question, some people just don't know what they don't know.
Yeah, no, it's fascinating. I mean, it's definitely something that doesn't get factored into proper underwriting of a deal as much as it should be, because it can obviously add up, and it's significant, and it's just the planning aspect that I think people overlook more than anything. They think about taxes, once a year, reactive based, but it's just like you plan your future with a financial advisor. Taxes in particular with real estate investing really, I think, should be treated the same way.
Correct. There's a very strategic way to plan and mitigate, rather than, to your point, be reactive and have your accountant on April 14th say, write a check, for $50,000 to the IRS because that's what you owe. And it is what it is. I know a lot of people that have told me much, much larger numbers than that. To your comment about underwriting and due diligence, these tax incentives will always be there in some shape or form. Many people are familiar that the Tax Cuts and Jobs Act that created the ability to apply bonus depreciation to cost segregation is in a sunset period. This year, a property that's placed into rental service only gets 60% bonus. It was 100. Now it may revert back.
I think there's something in the bill that's going to bring that back.
Yeah,
up to,
it's called the American Families and Workers Act. It passed the House 3 months ago, and it's been kind of quiet in the Senate. Through contacts I have, my understanding is it's not dead. If it doesn't pass on its own, there's some other bills that it could be attached to. So, fingers crossed. Or where I'm going with this is, as we talked, the government wants to incentivize people to invest in real estate. So the incentives will always be there in some shape or form.
Right.
Yes, will they change with different administrations? Is bonus sunsetting? Yes. They'll always be there. They're always going to prop up farmers and agriculture. That's just something that we need for the country. The incentives for real estate should never tip the underwriting on a bad deal becoming a good deal. a deal should always stand on its own merit as being a good deal.
It's that nice cherry on the top.
Yeah, to invest in. Yeah, cherry on top. I always say icing on the cake, or the gravy on top. They'll always be there, and they're great, and they're powerful tools. But a deal should be a good deal in and of itself. And I can't stress that enough. A lot of people will see a TikTok video. They'll call me up. Oh, hey, do I need to invest in real estate so I can get these tax benefits? Like, what can I buy? And I'm like, let's take a step back first.
Yeah.
So I really think that's an important message for everyone.
Cool. Well, Brenten, thanks so much for the education. I have a whole list of notes here. Awesome. I really appreciate it. For anyone watching, where's the best place to find you? What's the best place to get in contact with you? So I have a website. It is mycostsegregationpro.com. And I'm also on Instagram at My Cost Seg Pro. We'll hopefully have this podcast up soon. I try to produce content. But I mean, back to your question. The time to have the conversation is yesterday. Give me a call, send me an email, let's chat. I'm based in the Scottsdale area, but the federal tax code works the same in all 50 states. And I have the ability to do properties anywhere in the country. And one of the great things is after we talk and we chat, I can run a free preliminary analysis on any property that you own, that you're thinking about purchasing, to, estimate the tax benefits, deferrals, or deductions that you'd be looking at, what the cost of the work would be. An unfortunate reality. Not doing straight line depreciation does come at a cost, but that said, all the work we do is done with IRS approved software. Really smart tax engineers that are specifically trained in doing this do it. And it comes with audit protection. And then my team, myself, we have the guidance of understanding how to implement it. Your tax situation's different than mine. There's lots of legal levers and, ways to apply it in different ways so that, you, myself, whomever can take full advantage. Cool. Well, thanks very much for tuning in. And Brent, once again, I really appreciate it. You're very knowledgeable in what you do, and I definitely appreciate that. Cool. Thanks, guys.